Hello traders, and welcome to another weekly market forecast video. So hopefully everybody had a great weekend, and here we are into an interesting week of trading with the upcoming FOMC interest rate decision on Thursday, 7th of November. Obviously the US elections are taking place tomorrow. However, as we have informed and we always explain to our members the reality of the market, the US elections, they have really nothing to do with what the market is going to do in the short term. So in the short term, the most important thing should be the FOMC interest rate decision on Thursday, and also we have seen on Friday the NFP number very low, but the market has barely reacted here on Friday and bounced again. And this is because the overall market psychology is still expecting the FOMC rate decision and press conference to see how the Federal Reserve is looking into the overall market picture, and the more rate cuts that should be coming, the more optimistic the market can remain. So for the time being, the dollar index for this week, we have seen today the market trading lower. The overall bias from these levels is to the downside. However, in the short term, the market can play out more choppy, and it can create some volatility within the week. We will not be surprised if the market breaks the highs one more time before eventually it falls, or we will not be surprised if the market gives us a push to the downside this week and then makes another move to the upside before it falls. So those two are possible scenarios for the dollar for this month of November. So if you are trading any dollar related pairs, this is what you should be aware of in terms of both scenarios in this specific case. The bigger picture will be to the downside from these levels 105, 104 area in general. Now for the dollar yen, we have got our reaction to the downside overall as we expected from the previous weekly market forecast video we have made. However, the way the market is trading at the moment, it's very likely that we might get one more push to the upside. However, in the short term, again, it really depends on how we will trade into the FOMC. So if the dollar will make one more low, this one will make this move, and around the 148 area, it might find further support for another bounce. So overall, this is the picture for the dollar yen. For the time being, we are overall looking for a reaction to the downside first before anything else can take place. So this should be the case into the week into the dollar yen, unless we will see any surprises from the Fed on Thursday and no rate cuts. However, given the fact that we have seen a negative NFP number, it suggests that further weakening in the jobs market in the US, it means that more potentially aggressive rate cuts can follow. So this is what you need to bear in mind when trading the dollar yen, that any significant rate cuts its dollar weakness, and this pair should be reacting to the downside towards the 148 area if we get that within this week. For the euro, we have got the reaction to the downside from the 25th of September as expected from this Fibonacci extension area. So from there, we have been explaining that the market will remain sideways to lower below the 109 area. Then the market broke here this high from 18th of October, and this is a corrective reaction to the upside, which suggests that the market, it doesn't look fully ready yet for a bigger push to the upside. So the highest probability is to see another move to the downside before a reaction to the upside, but you need to be aware that there is a likelihood that this move to the downside can break these lows one more time before it pushes up. So it really depends how the market will be trading before the FOMC and what should happen with the interest rate decision. So you should be cautious during the week and get the market day by day if you are trading the euro. So for us, this is not the market which looks ready to do anything significant because the market can remain overall trapped between the 1010 and 107 area for longer before the market is ready to make the next trend either to the upside or to the downside. For the pound, similar to the euro, we have this reaction to the downside from this Fibonacci extension area, which was expected. So the market during the month of October has showed us that is sideways to the downside, as we have explained in our previous market forecast videos. So we can see more sideways pound for the next coming days. Perhaps a decision can be made after the FOMC interest rate decision on Thursday. Until then, be aware that this pair can remain sideways and do nothing in the next 2 days. So it really depends on that outcome on Thursday onwards. Also, there is a likelihood of one more push to the downside before it pushes to the upside. So be aware that this structure here can extend into something bigger and sideways before the market reacts to the upside later on. So that's our view for the pound for the coming week, more sideways into the 129 and 30 area. Now for gold, of course, as you know, we have been biased to the upside since a long time. We have been explaining all along between May and June that we expected a trend to continue to the upside. This is a bigger target area we're trading in the weekly time frame. The way the market is reacting right here, it's probable that we might get a pullback, which looks like because we have got a new high here with divergence from the previous peak. And also we have a break of this RSI trend line from here, which suggests that there is some sort of a weakness in the 4-hour time frame in gold. So we have got this move to the upside with another buying area that we explained to our members. So if you are not still a member, you can check us out with the link in the description. We do cover a live session every Wednesday and Saturday. And also we provide trade recommendations, the ones that we believe they can give you a higher risk to reward ratio. However, if you're an experienced trader, you can take additional trades when you are using our service because we give you all the detailed analysis every live session and during the week if we see something that is worth looking at. So also we have this buying area from the 10th of October, which gave us this move to the upside. This was a more aggressive buying area in the short term last week. We have got one more high and also we have satisfied the inverse Fibonacci retracement, even the 2.272, which provided this target to the upside from this pullback we have got here. So now we might be expecting more volatility in gold this week. So depending what happens before the FOMC, if there is an interest rate cut, then gold will make one more push to the upside. If by then we get another move to the downside, then the FOMC will still produce a push to the upside. However, be mindful that at this stage, the market is showing us signs of a possible weakness, or at least sideways to lower price action can take place before it goes up one more time. So it all depends, as we said before, what happens before the FOMC, and if there is a decent rate cut, then gold is going to react higher following a rate cut from the Fed. For oil, after we got the expected reaction lower from this Fibonacci extension area, the market has generated a bounce last week, and we can see that from this move to the downside, we have finished a first part to the downside, and now we are retracing between the 38% and 50% Fibonacci retracements. Here we had a gap lower last week on Monday. And this move to the upside has filled this gap as many times the market can do. And from here, we can expect some more sideways price action before oil is able to make the next push to the downside, which we are still biased to the downside in the bigger picture. Not in the short term, but in the bigger picture, we are biased to the downside. We have been saying that since a long time. If we show you the daily time frame, we are still lower from March 2022, and we have selling areas since April this year, July this year, October this year, and we are looking ideally to continue lower and break the 60 area in oil. We have been explaining this to our members, by the way, over the last couple of months. So if you want to know the levels and the bigger picture in oil and why we are biased to the downside, feel free to join us with the link in the description, and we will be more than happy to provide additional and detailed information for you if you are interested in crude oil in specific. From the indices, the S&P 500 cash index, we have got the move to the downside that we expected from the week prior that we explained in our previous video. And we have reached a potential reaction area, which is this Fibonacci extension area we are trading at the moment. So from here, we are expecting a minimum bounce to potentially fill this gap that we got on Thursday. And from there, the market should decide whether the S&P will do a double correction lower, or whether this is a buying area in which has enough buyers to push this one to the upside. So again, it all depends on how things will develop before and after the FOMC. So interest rate cut, it means S&P 500 ideally continues to the upside. However, it really depends on the other data as well, whether the press conference will have Jerome Powell saying about potential bigger recession, or whether things should be gradually improving after another low NFP. However, we have to note that the unemployment rate in the US remains stable at 4.1%, and this is why the market at the moment doesn't feel any fear or panic of a bigger recession, because unemployment rate remained stable. We can overall see both scenarios as of today, Monday. So it really depends what should be the case. If we get the double correction, we will have another potential buying area lower, which we will present to our members if this takes place. In either case, we are expecting the market to remain supported for at least the next month or so. Depending again which scenario is going to play out, this is a market that you should only be looking to buy the dip and not sell this bullish market that has higher targets than the current prices overall. And concluding our weekly forecast video with Bitcoin in the short term. So for Bitcoin, we have hit a target area that we expected over here at the 73,000 area to 80K area, and we are having a reaction which it was probable. So we are soon reaching another area of interest that can generate more buyers and continue the trend to the upside for new all-time highs, which we have been explaining to our members all over the summer that Bitcoin is not going to go anywhere. And all it did, it was a sideways zigzag corrective structure, which obviously after a big push to the upside we had in 23 and the first part of 24, it had to do some sideways price action. From the 5th of August, we have got buyers from this Fibonacci extension area, and now we are looking to accumulate for a new cycle to all-time highs. Of course, we have possible targets to the upside. If you want to know them in the bigger picture, feel free to join us with the link in the description, so you can join one of our live sessions that we do for the members. Also receive our weekends live session and possible recommendations. We have got the longer term analysis in the crypto market since March, April this year. So our members are aware what should be expected in the next coming months and year ahead. So feel free, check us out. And if you have any questions, send us an email at support@roiforecast.com. Or if you want, you can also leave us a comment if you want to give your feedback overall. So this is what we see. Bitcoin should soon find more support and break to the upside. We are looking to break the 75K area and head even beyond 80K. So that's our view, whether we do it from this area or whether we do something like this, a double correction, and then go higher. This is not going to change the bigger and overall view. So for now, this is the buying area for Bitcoin, the 66K area, which we are almost there. It doesn't need to reach it, but if it does, this is a probable area that buyers can look for the next push to the upside. So that's what we have for this weekly market forecast. As I said, we are expecting things to get clear from Thursday's FOMC. We are not expecting anything regarding the US elections and the effect to the market because traditionally we have seen that it doesn't matter what the US elections will do because at the end of the day, the market always runs ahead of time and what was supposed to happen will happen in the market regardless whether Trump or Harris wins this election. The impact of the elections is for the more longer term view of the market because the new president will be out of office from January, February until they see what they're looking to change. It's going to take another half a year at minimum. So nothing matters in the short term rather than the long term. And most importantly, the FOMC rate decision will be more important than the US elections themselves within this week. So that's our view and how we see things from experience and through the years. And that's why we also share this with you so you can know what to expect. Also, as we said before, if you are serious about having proper analysis and education about the markets, you can become part of our trading community. The link is in the description, and we will see you in the next video. And stay tuned because we are changing our uploading schedule, so you are going to see from us from this week more weekly daily content, and we will be looking to showcase many things to you here for the public, and also we are planning to do certain podcasts with some other interesting people so you can get to know us a bit better and where we're coming from and what are our views in generally, not only for the markets but many other things in general that are related, so we can help you and give you more value and education, which we believe that this is what it's all about. Because at the end of the day, we are still seeing that unfortunately still 80 to 90% of the retail traders, they are losing money on the yearly basis, and this is what we are looking to potentially solve to as many people as possible. However, you need to want this to happen for you personally. We cannot force anyone to learn, of course, but we are here for those that really want to learn and they really want to take it more seriously. And also, we will try to help you to prevent following potential scammers and people that they will, let's say, take you to the wrong approach of trading just to get something out of you personally. So that's it for today. We will not go longer to any more details. Expect from us more content, of course, as we go from this week onwards. And don't forget to leave us a like, subscribe, and see you in the next video.